Today, we're taking on one of the most common questions we get, and one people feel really strongly about. Should you pay your mortgage down early with extra payments? And I want to do it, honestly, because there's a good case on both sides.
Yeah. And I mean, up until 4 years ago, rates were in the 3% or maybe lower or something. So it's a little different than today's rates, right?
That's right. Yeah. I mean, when it was 3%, if somebody's got a 3% rate, the math almost always says don't bother. Rates are up to near 7 now, and 7% the case for paying it down gets a little bit more interesting. So the answer has really changed with the environment. So that's what we're going to talk about today.
Yeah. So before we get into the for or against argument, there's kind of like there's a right order to think about this, right, Craig?
There is, and there's actually good research on it. The Federal Reserve Bank of Chicago did a study on exactly this: mortgage prepayment versus funding your tax-deferred retirement accounts. And they found that more than a third of the households who were rushing to pay down their mortgage were actually leaving some money on the table because they should have first been funding their retirement accounts instead.
Yeah. So retirement before extra mortgage payments.
As a general rule, yeah, fund the tax advantage retirement first, especially if there's an employer match, because the match is an instant guaranteed 100% return on that money that you can't get anywhere else. Then once your retirement's on track, extra mortgage payments become a very reasonable next move. But we'll put the study in the show notes so people can read it themselves if they're interested.
Yeah. So let's make the case. Why do it?
So a few reasons to pay the mortgage down. It's a guaranteed return, right? Every extra dollar you put against a 7% mortgage saves you 7%, guaranteed. It's no risk. You're not going to lose any money. No market investment can really promise you that. At today's rates, that's a genuinely strong, safe return. And you own it free and clear one day. That's the American dream for a lot of people. No payment. The house is really yours. And there's real peace of mind in that. And you can save a lot in interest. Over a 30-year loan, even modest extra payments can knock years off the loan, save tens of thousands of dollars in interest. And for when you retire, then you have no payment in retirement. So you're walking into your retirement years without a house payment, changes your whole cash flow picture when you're on a fixed income when you will need that. And it's more resilient. Your lower fixed obligations mean you're harder to knock over if your income dips or the economy turns. And then honestly, discipline. Some people actually make the extra payment, but wouldn't reliably invest the difference. If that's you, the mortgage is a forced savings plan.
Yeah. Now the other side of it, not to rush into it, like not too fast. What's the case against it?
Yep. So liquidity first. Do you have an emergency fund? Money you put into the house is stuck there. You can't easily get it back without a refinance, a home equity line, or selling. So you don't want to be house rich and cash poor. You definitely want to have a safety net of liquid available funds before you start accelerating paying off that house payment, because once you put it in, then you might need to talk to somebody like us just to get that money back. So that's one thing. Yeah, retirement first, like the Fed study said, match and tax advantages usually beat prepaying. Opportunity cost. If your rate is low and the market has historically returned more than the mortgage rate over the long run, the difference is going to win. So the gap is narrower at a 7% interest rate, but it's still the question: what can you earn over time versus that expense? One interesting thing a lot of people don't think about this is inflation. We talk about inflation a lot because it affects mortgage rates. Inflation is on your side when it comes to helping you pay your mortgage back over time. We've talked about this before, but a fixed rate mortgage is paid back with future dollars that are worth less every year. Even when inflation is low, we still have inflation. And so the dollars that needed to be paying back this fixed rate 10 years from now are going to be less than those dollars are worth now. And so it's going to feel easier to make that payment as time goes on. At the same time, inflation tends to lift the value of your house and lift your investments at the same time, over time. So pay it down slowly and you let inflation do some of the work for you. And another reason would be, hey, if you have other higher interest rate debt, knock that stuff out first. Of course, credit cards, 20+% interest rate come before a 7% mortgage every time.
Yeah, that's always the first thing to knock out those higher interest rate credit cards. But the first thing you talked about was the liquidity. first. Let's kind of dig deeper into that. That's really the most underrated one as far as liquidity is concerned.
It's huge. Again, if you put your money into your house, to get it back, you got to apply for it. Refinance, HELOC, or sell the property. And a lender decides whether to hand you your own money. And the cruel part, the moment that you might need it the most, so you lose your job, you have a medical event, your income dropped, the economy tanked, is exactly when you might not qualify to pull it out. So lenders lend to you when you don't need it, not when you need it sometimes. So money in the house is money whose control you've handed over to some future underwriter.
Versus cash in a liquid account.
Right, which is yours today, no application. It's still working for you. Picture $50,000. You put it against a 7% mortgage and you save about $3,500 of interest that first year. Real, but now it's locked in the walls. If you put that same $50,000 into a liquid account earning 7%, and it earns about $3,500 too, except it compounds and grows. So it would go to 5,350 and then 57,200, and the dollars it throws off climbs every single year, all while staying completely in your control. You don't have to go apply for it. As time passes, your invested balance grows while your mortgage balance shrinks. So the interest your money earns pulls ahead of the interest that your mortgage costs you because of compounding.
Yeah, so when you look at those two things on paper, it's basically a wash because of the rates.
On paper, it's close. A guaranteed 7 saved versus 7% earned. The real world edge is the control. Your invested money stays liquid, keeps compounding, and can go into tax advantage accounts, where the money in the house is locked up and it only comes back if a lender says yes.
So is there a real honest answer there?
I mean, the honest answer is it depends on the individual person. Line up a few things. How's your rate? Is your rate high or low? Do you have an emergency fund already? And your retirement funds being funded and on track? Have you maximized those? How close are you to retirement? And this is the biggest thing. Be honest about whether you'd actually invest the difference. If your safety net and retirement are set and you value certainty and a paid off home, extra payments are a great use of money, especially at today's rates. If you're still building your cushion or you've got a cheap rate and you'll truly invest instead, slow and steady paying that thing back, don't prepay it, could serve you better.
Yeah. Yeah. So one honest caveat on the whole keep it liquid argument, correct?
It's a big one. The discipline. Keeping your money accessible only wins if you actually leave it invested. If having cash on hand means you could turn it into a boat or a vacation or you start living a better lifestyle for fun, then the liquidity advantage, you're eroding that. And then maybe for somebody like that who's more inclined to be that way, maybe the forced mortgage pay down is a better plan because there's built-in discipline. So I'd say you got to be honest with yourself. Liquidity is an edge only if you don't raid that liquidity for other reasons.
Yeah. Yeah, that makes sense. I mean, we're really looking at just, hey, build your retirement versus pay your mortgage down in a sense, right?
Yeah. I mean, that's the most conservative thing to do. And so the good thing is you can see these in your own numbers if you want. There are different things online, but we put something on our website where it's basically a calculator to look at exactly this. So all you do on our website, we'll put a link in the show notes, is you put in what do you owe, what's your rate, and then how much extra you're looking to pay against the loan. And it's going to tell you over time how much the extra payments are going to save you in interest and how much earlier you pay the loan off, and versus if you took that money and invested it instead and what the difference looks like. So you can play around with it. There's no login. You don't have to put your email address in there. It's just a little tool on our website that you might find handy. So
yeah, it's free. There's no login, right? We're not trying to sell you something yet. But no, it's all good. So no, I think it's a great idea.
Yeah. So bottom line, fund your safety net and your retirement first. Paying your mortgage down early is a smart, guaranteed way to build security. Just wait against liquidity, your rate, the quiet help you get from inflation. Run it through the calculator, make your own call.
Yeah. And if you have any questions, feel free to reach out to us. Sometimes people, I think we talked about that maybe last week before, that if they do have a 3% interest rate, maybe they don't want to refinance it, we could do a fixed rate second mortgage, a very, very competitive rate.
Yep.
We pay off some extra debt you might have, or maybe medical stuff, or save for college or something like that. So you don't have to refinance that low interest rate first mortgage. You keep that, just get a small second mortgage.
That's a great idea, and I think that we'll do a future episode probably on that topic independently. So, do we want to talk about rates for a second and just the current?
Sure. Yeah. I mean, we had the jobs report this morning came out, and not what they were expecting.
So the bond market liked it this morning. The jobs market, the jobs report, we were expecting 80,000 new jobs, and it was actually lost 23,000 jobs or so. So about $100,000 swing.
That's a big swing. 100,000 jobs. That's a big swing.
It's a big swing. Somebody came out right away and said, well, that's due to, if it wasn't for the World Cup, all the people that were employed for World Cup now being over, that those decreased, that we might have been up 100,000. So I don't know. We'll see. There's always revisions.
Sounds like somebody's trying to make an excuse, I guess, but I don't know.
Some spin. There's always everything's getting spun these days. So but so for now, the bond market likes it. Usually, the worse the jobs are, that's one of the big drivers of inflation. Hot jobs market is employment inflation, wage inflation, and that's usually bad news for mortgage rates. So when there's less jobs, the bonds can do better, and that leads to mortgage rates getting better. So nothing dramatic has happened today, but generally speaking, the bond market likes it, and we're better on rates today than we were, let's say, at the beginning of the week. So
still some in the mid to upper sixes, and still in that ballpark. Nothing dramatically changed, right? So, but good stuff. So
so we just have to keep our eye. Next week we've got an inflation report, and hopefully that will come in benign. So
yes, let's hope.
All right,
good stuff. All right, so we will see you
at the closing table.
The closing table.
Yes, sir.
All right, have a great day.
Have a good one, sir. Bye.
See you.
Thank you for watching and listening to the South Florida Mortgage Report, brought to you by Capital Partners Mortgage Services.